please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This is Bazaar Morning Call, live from the CNBC TV-18 headquarters in Mumbai.
Welcome to Morning Call. I'm Latha Venkatesh, with me Anuj and Surabhi. Well, we are waking up to a bunch of new calls. The first one of them, of course, was the S&P update, which maintained the status quo. On Friday, we were still wondering, and there was a latent hope that with one agency pulling us up, the other one would at least give us a positive outlook. So that would perhaps impinge a bit on the bond markets for sure. We should expect, we closed at 705 perhaps as the worst case when we open. The rupee will not react, obviously, because the dollar has fallen so much that any negativity because of S&P is countered very easily by the dollar's global weakness. But the fact that you normally need two rating agencies to give you an upgrade for the global markets to, or for markets to bring your yields down. Now that that is not there, we definitely are going to see a bit of a negative sentiment on the Bank Nifty. Bank Nifty was the one that soared on the day the Moody's rating came. Today, that perhaps will see a bit of a negativity as well. Crude prices are higher. I mean, we are dashing towards 64. So that also will impact, and you will see higher yields, and therefore NBFC and banks should be impacted. But otherwise, I think we are going to follow Asia, and Asia is not giving us very warm clues.
Absolutely. It looks like a bit of a Monday blue setting in as we are starting off. Latha, as you're saying, good morning. So let's actually pull up the Asian markets, because some of them are now actually down over 1%. So worth taking that into cognizance, particularly the South Korean markets. They are weaker. And remember, we were talking about China, mainland China, and what is happening there last week. That market's still a little vulnerable, as is the Hong Kong Hang Seng. So that's the picture across Asia. Not too good. But having said that, it seems the US market rally, there is sort of no shaking that up, because after the Thanksgiving holiday, those markets managed to touch yet another record levels, and now everybody's talking about holiday sales and spending. So there the optimism seemed to be intact. Crude oil prices, as Latha already pointed out, let's just get the figure on the screen as well, because it's moved to the higher end of the trading range. It's been very range bound between 62 and 64, and now closer to the 64 level on Brent. Thursday deciding factor. Markets already factored in an extension of those OPEC cuts. Let's see how that goes. But Anuj, good morning. And my first question to you is this. On S&P, I mean, so we didn't get an upgrade.
Yes.
But I don't know, this market has rallied without looking for validation from rating agencies in any case, right?
Morning, Surabhi. And if S&P upgrade had come, maybe you would have had a sell on news. Now the market will have this at the back of the mind that would remain a trigger for at some point this year. And I'm sure S&P didn't want to be a Me Too kind of agency, and they are the bigger agency, of course. So, but I attended this investor carnival over the weekend, Surabhi, and I think the investment cult in this country has just started, and that I think is telling me that this domestic liquidity is really going to be the big trigger going forward. My basic thesis is that while the SGX Nifty is indicating we'll once again fall back in that range, and that breakout that we had on Friday was a fake breakout, the broad thesis is that the correction is over. Unless, of course, you start to see capitulation in the global market, which is not the base case. So the correction is over, and the 20 DMA of 10,325, which was acting as resistance, may now act as support, at least for starters today. But the index needs a trigger to break out. I think today is the time to just focus on IT stocks, and there are 3 or 4 reasons for that. It's a sectoral leader now after a long time, and stock leader as well in terms of Infosys. In fact, this month Nifty IT is up 4.5%, while Nifty is up only 0.5%, and Infosys is up 10% this week, almost at 52-week high, and has taken out the pre-Sika level. So I think you focus on IT today, that and rupee, if it falls a bit, it would be a bit of a tailwind. The big question is how much will the Bank Nifty correct due to this S&P disappointment. I think that's something that we'll find out. But short of any major disappointment, I think my broad thesis is that the correction might be over. This is expiry week as well, so if we defend the last week low, then maybe with global Q supporting, we could move on. By the way, talking about those US market, I think just go to Twitter and search some of the sales which were happening, the Black Friday sales,
the queues, etc.
People falling over each other, literally hitting each other. I think that's what's happening in US market with stocks as well. The likes of Amazon, Facebook, and even bitcoins and all that. So I think that really is a completely different bull market altogether.
Okay, well, on that note, let's actually get you a couple of calls that we've got going as we look at trade this week and this Monday. Well, this is one view coming in from Jeffrey Dennis of UBS. He says, despite 2017 slowdown, India remains top of the EM growth league. He says, for 2018, UBS forecasts GDP growth of 7.4% for India versus 6.4% in China. He adds, with the market rising sharply in 2017, ROE and price to book value ratios look high versus India's history and other emerging markets. However, he sees support for India's high valuations because of GDP growth, reforms, stronger RBI and a more stable rupee.
Okay, well, but that's slightly in the longer run. The GDP number that will come on November 30th perhaps may not be so flattering, but that's going to be a very difficult GDP number to believe in any case. Well, let's get more equity calls. Jonathan Garner of Morgan Stanley forecasts only a 3% upside from current levels in the base case for both Japan and emerging markets, but a considerably higher 9% for MSCI China. He says China becomes their largest overweight whilst they reduce their overweight on India from 250 basis points to 150 basis points. But nevertheless, it's an overweight.
Okay. So after those equity calls, let's get you some money market views as well. Pramit Brahmbhatt of Veracity says the rupee is likely to trade sideways today with a positive bias. He is expecting the USD INR pair to trade in a band of 64.50 to 64.80 for the day.
Yeah, I guess that's because the dollar is really weak, 92.8 and something. Okay, on the bonds, Ajay Manglunia of Edelweiss says the volatility of the previous week is likely to be followed by relatively range-bound trading with a negative bias. Says the euphoria of the rating upgrade and the open market operation sale withdrawal, OMO sale, has been tempered by the other prevalent concerns, and the rating status quo by S&P might also prove to be a dampener. Says the markets will await GDP data release later this week and also keep a close watch on the crude price trajectory. He says the 10-year benchmark bond yield is likely to trade in a range of 6.98, 7.03 today.
Okay, over to Mangalam now then for the world view.
Well, the queue started in the green from the US. Along the way to India, they turned red. That's as far as the world view is concerned. Because if you take a look at the US markets, all of them ended at a fair amount of green. The S&P 500 at record high, above that 2600 mark. Investors really betting on the shopping season. You spoke about the videos that you saw on Twitter. Just take a look at a couple of stocks that moved, and they tell a telling story. Macy's, the retailer, was up. Amazon was the one that gained. And how do you pay? You pay via your card. And Visa, that stock gained too. In Europe too, there was a mixed sort of moves as far as the main frontline indices are concerned. The FTSE was down 0.1%, while CAC and DAX, both of them gained. But the sentiment out there was more about political instability, because if you take a look at Ireland, there were calls in Dublin to remove the Deputy Prime Minister. Germany too, we are seeing some fresh coalition talks as against the fresh election talks. Apart from that, in the emerging market space, absolutely divergent. Green in Russia, red in Brazil. But the Asian markets, the Nikkei opened in the green, now is in the red. They have extended losses across all the four key Asian indices. And as a result of that, the SGX Nifty indicates a cut of almost 40 points at the top.
Okay, thank you very much for that summary, Mangalam. But we will, of course, continue to speak about the big story of the morning. Rating agency S&P has dashed hopes of yet another rating upgrade within a week. That happened last week, Friday. Ravi Bhatia, the director of sovereign ratings at S&P Rating Services, says India's fiscal story is weak. Adds that high oil prices and weak consumption trends could pose downside risks. Listen.
The growth story is good, but we've seen a bit of wobbles at the moment with a couple of quarters of slower growth. The reform momentum has actually been good. I mean, there's been a whole host of reforms pushed through. But again, there have been some sort of teething problems on the reforms as well. India has a number of strengths. I mean, as we mentioned in the report, the external story is really looking quite strong these days. Current account deficits are low. That's partially helped by the recent years of lower oil prices. And also the reserve story is really good with over 6 months of import cover. We look across the board at various factors: institutional, economic, GDP per capita, monetary, fiscal and external, and India has definitely got some strengths. External is very strong, fiscal is weak. So it's a combination of factors, and our criteria are comparative across all countries. So we use the same framework for all countries, really. We look at deficits, fiscal deficits on a consolidated basis. That is adding the, or what we call general government basis, which is adding the states and the center together. And still, when we combine the two, the deficits are high. India issues most of its debt domestically, so there isn't really an exchange rate risk there. And also, as you say, they're on this glide path, so hopefully the deficits in terms of stocks will come down, and we'll be watching that. Broadly, the plan looks good, really. The banks have been suffering. There has been this issue of NPLs. They've needed the recap to reach the Basel III, to meet the Basel III requirements. So this plan is broadly good. And also lending has been weak, so hopefully this should help that. Although, I mean, we have concerns also on the demand side that lending is really it's not only been a supply side and credit supply issue, it's also been a weakness on the demand side. But broadly, we're expecting an improvement.
A bit of a tough morning as far as Asian cues go. We've been telling you that, and that's the SGX Nifty. It's pointing southwards by about 40-odd points right now. Let's also now focus on stocks and the ones that should be on your radar. As always, our entire team is here with the CNBC TV-18 list of top stocks for the day. Good morning, guys. Gear up. Happy Monday. Well, Anuj, let me start with you. You already flagged off IT as a sector to watch.
Yes.
In terms of stocks?
Yeah, in terms of stocks, Surabhi, I think with a caveat that, the Asian screen is looking a bit wobbly, but I won't be surprised if Asia starts to sort of, stabilize. In that case, for our market also from lower point, we have a recovery, and we might actually try to go into the green as well at some point. In terms of stocks to watch, I think Titan and PC Jewelers. This is the weekend news that this package for gems and jewelry sector likely soon. And I think that's official word from the Commerce Minister, Suresh Prabhu. He spoke about this package over the weekend. And both Titan and PC Jeweler, I mean, they didn't really even need a package. They have been in a strong bull market. Titan is up 30% this month. PC Jeweler is up 10% this month. So obviously, Titan is a much stronger stock compared to PC Jeweler. But, because both are in F&O, so you may want to keep both these stocks on your radar. And, as I said, Infosys. So it's been my stock to track for some time now. It's now within a whisker of pre-Sika levels. The day Sika quit, it was at 1,020.
Actually, it went there on Friday.
It went there on Friday.
Yeah.
And look at the delivery volumes in Infosys over the last 3 or 4 days, and there's been huge buying, the currency angle as well. And once again, the move in Infosys over the last 2 or 3 months reaffirms that if you stick to some basics, you'll get it right. Infosys always bottoms out at 12 or 13 times 1 year forward earnings when these sort of black swan events happen. And this time as well, right like textbook stuff, bottomed out at 13 times 1 year forward earnings. Of course, there's an issue of buyback and limited stock being available for selling. But who cares? Right now, you are getting good stuff in IT. And as I said, if rupee also weakens a bit, that would be added tailwind, of course.
Okay, so the jewelers along with Infosys.
It's unlikely to weaken because of the damn dollar.
Dollar being so weak in the last couple of weeks. But okay, Latha, let's talk about now S&P. Of course, sentimentally, it makes everybody unhappy. But in terms of stocks, and whether banks will react negatively.
That's the only thing. That's the only thing we should worry about at the opening. I mean, the bond yield is likely to go to 7.05. As well, you have the crude, reaching out to 64. For both these reasons, the bond yield will go up. And that will be, of course, a mark-to-market negative for all banks and NBFCs. For them, it's not a mark-to-market negative, but a sentiment indicator that cost of money is rising. And now it is back to basics with all S&P and stuff going away. Now you will have to watch for crude. You'll have to watch for the monetary policy, which is just about 14 days away, not even 14. I guess 10 days away. And there, with this kind of a backdrop of crude, and Manisha was telling us in Power Breakfast about how metals are charging ahead. I mean, I can't see the MPCs saying anything but, pointing out to the fact that we are a little worried about how inflation will turn out. So I think the bond market will start putting in all that, and then come February, will there be more borrowing? It is going to be biddish bonds, and therefore that bit of a negative is there for the Nifty Bank and NBFC.
That could be a bit of a negative, of course, for NBFCs and maybe even the banks, especially the PSU ones. But let's move across to Anisha. We have the stock of the day, Larsen and Toubro, and also she's watching for some railway electrification stocks as well. Anisha?
Well, yes, L&T will be in focus because reports suggest that Schneider may be looking to enter into exclusive talks with the company for its electrical business for around $2 billion. Now, this is not the first time that we're hearing this news. We know that the likes of Schneider, Temasek have been in the fray to buy out this business for around $2 to $2.3 billion. Now, this business is not very big for the company, 1% of the order book. Though, yes, the ROEs are strong at 20-23%, but remember, the growth is what has been lagging, and this business has been on the block for L&T for a while, so we might see a bit of reaction on that. The other reason why L&T and the likes of Kalpataru, KC, etc. might be in focus is because the government is planning to bring up a big order when it comes to railway electrification. Remember, the Minister Piyush Goyal had set out a target of electrifying railways by 2020. Now we understand around 7,000 kilometer worth of orders may come in this year itself. And also another important factor to note is that earlier this order was split into very small sizes of 30, 40, 50 kilometers, and now we expect that these order sizes can be much larger. So the likes of L&T and the bigger players like Kalpataru stand to benefit on that, and maybe we'll see some, kind of excitement building up on those counters today. Back to you.
Okay. All right, Anisha. Thanks very much for that. Yes, electrifying all of railways by 2020. Those are the kind of targets the ministry has put out. But good morning, Ekta. Now, what about Sun Pharma? There was a drug recall announcement on Friday. Is it serious?
No, it's not. It is going to be a marginal negative for Sun Pharmaceuticals. They did make this announcement to the exchanges, I think, just as a precautionary measure. This particular drug, it's a diabetes drug called Riomed generic, where it's only a recall of around 2 lots, which they've done in the US, and the US FDA is, aware of this particular recall. It's a class 2 recall. That means that it should not have any adverse impact in terms of usage. But there was a microbiological contamination in these particular 2 lots, and that has resulted in the voluntary recall which is undertaken by Sun Pharma. Important to note that it is also manufactured by a contract manufacturer, not directly by Sun Pharmaceuticals, and hence it's just going to be a marginal sentiment impact, because still it's a recall, so there's always a little bit of concern, but there's no fundamental impact.
Okay, good to hear that. But from sun to solar, Nimesh is watching all the renewable stocks.
Yes, Latha. So this could be a potential, booster for all the renewable stocks, given that, over the weekend, the renewable minister made an ambitious announcement of auctioning capacities of close to 25 gigawatts by FY20. What this means is, at least from Q4 of FY18, 4 to 5 gigawatts of orders are likely to come through the way for the likes of Suzlon, Inox Wind, and PTC India. So, clearly a big booster for these stocks, because they've been, completely underperformers for the last many years now. This could be the kicker, what they were looking out for. This also means some positive for wind turbine manufacturers. But to start with, I guess it will be green for Suzlon, Inox Wind, simply because they've so much underperformed in the last many years now. And this is what probably, as a booster can come to for the likes of Suzlon and Inox Wind.
Okay, Nimesh, thanks a lot for that. So that's a space to focus on, but some earnings still there, and Ronit is tracking them. Ronit, more good than bad?
Yeah, Anuj, so a lot of mid-cap and small-cap companies reporting the results. So I'll start with Bharat Bijli, strong set of numbers coming in, revenue up 20%, as well as they reported EBITDA profit versus the last quarter, but the PAT was down 3%, largely due to a reduction in the other income, so you can expect that stock to be in the green. Moving on to Excel Industries, strong set of numbers coming in, revenue was up 9%, but the EBITDA margins, what stole the show, came in around 500 basis points higher, largely because the top line grew, but the expenses remained constant, as well as the PAT was up 83%. Moving on to Oriental Carbon, an inline set of numbers coming in, revenue was up 7%, as well as the EBITDA was up 7%, but reduction in the PAT came around 16% lower. Back to you.
Okay, thank you very much for that. What the hell, yeah? 60 days into the quarter and into the next quarter, results still trickling in. Anyway, good for us that it's more good than bad. Thanks for that, Ronit. Okay, Naveen, some other stocks in news?
GHCL will be clearly in focus today, Latha, because DSP BlackRock has bought close to 1% in the company. Remember, GHCL is one of the biggest soda ash players in the country, and they have been clearly benefiting on the back of shutdown in US as well as China in the soda ash plants. On the other hand, GPT Infra, that stock is expected to be in green in today's trade. Remember, they have won an arbitration against NHAI worth 62 crores. Why is it important? Because the total market cap of the company is just 500 crore. But remember one thing, the stock was already up 10% on Friday. On the other hand, Satin Creditcare, a bit of more dilution, but nevertheless they are raising almost 200 crore via different entities, which includes the promoter as well as some other big funds like Nordic Microfinance, Cora Investment as well as IndusInd Bank. Remember, the raise will be via convertible warrants as well as convertible preference share. Last but not the least, Autoline Industries, again a green on this stock also on the back of the company getting an environmental clearance for its proposed special township projects. So all these stocks will be in green in today's trade. Back to you.
Okay, sounds like plenty of green on our list this morning. Thanks, Naveen, for that. Let's recap that list now. So stocks expected to gain include L&T, Kalpataru, KEC International, Titan, PC Jewelers, Infosys, Suzlon Energy, Inox Wind, PTC India, GHCL, GPT Infra, Saturn Credit Care, Autoline Industries, Bharat Bijli as well as Excel Industries. Stocks that could see some pressure this morning are, of course, the entire banking universe because of what's happened with the price of oil and the fact that S&P has not upgraded us. And, of course, we'll look out for the Nifty Bank for the same reason, as well as the PSU Bank Index and NBFCs like HDFC, Bajaj Finance and Indiabulls Housing. Also expect some red for Sun Pharma as well as Oriental Carbon.
All right. With that, let's switch back to the big story of the morning. The status quo rating given by rating agency S&P, joining in to assess the likely impact and any key takeaways from the S&P are Sajid Chenoy, the chief economist at JP Morgan, and Anant Narayan, now an independent expert. Good morning to both of you, and thank you very much for joining in. Well, Sajid, anything to worry about what S&P said, or was it on expected lines?
No real worries, Latha. I think the interesting distinction between S&P and Moody's is one has taken a more strategic view on India, the other has taken a more tactical view. I think there are two realities here, and I think the ratings agencies' approaches reflect those different realities. Moody's is more excited by the fact that we've had all these structural reforms undertaken, and they've forecast potential growth to pick up meaningfully in the next 3-4 years. Implicit in their assessment is the fact that that itself will bring debt to GDP down, even if the consolidated fiscal deficit does not come down very much. That underpins the Moody upgrade. S&P takes a more tactical view, worrying about that consolidated fiscal deficit. You know, it goes on to talk about how state deficits are going to remain close to 3%. There is not much expenditure flexibility, especially given more public investment requirements. The tax to GDP on a comparative basis is still relatively low. So I think I was struck by just how many references there were to the fiscal and public debt for S&P. And I think that underpins the fact that they want to see...
Yeah, Sajid, you know, that is exactly what I want to ask you. Do you share that fear?
You know, Latha, to be fair, we have come a long way over the last 3 or 4 years, but it is equally true that over the last year, some of the fiscal risks have increased. I think we've written a lot about state finances, basically undoing the centre's fiscal consolidation in the last 4 or 5 years. So the consolidated fiscal deficit really hasn't moved very much, number one. Number two, you know, there are some concerns about what happens to growth in GDP in the near term, and therefore whether the government can stick to its existing path. And number three, the elephant in the room is oil. If oil continues to trade higher, that, you know, will have some impact on the fiscal eventually. So at some level, I do share S&P's near-term concern, but that said, you know, we still expect debt to GDP to come down slowly over time, given that growth is expected to pick up.
Okay, no, I was actually more worried about how much borrowing there will be in January and February. Well, Anant, your thoughts on how the bonds will open, and more importantly, this fiscal question. Are you expecting more borrowing in Jan and Feb when the timetable leaves it light?
Hey, morning, Latha. I think the bonds could open a little weaker, purely from a sentiment perspective. You must remember that, frankly, rating agencies should not impact, our local bonds in a direct way, given that the overseas limits are almost completely full. In fact, given the choice at 7% 10-year bonds, I think a lot of overseas investors would love to buy, except there are no limits available. So you might see a bit of a slip up, given correction and oil prices and all of that. But I think the big level to watch right now is 705. That's when the RBI cancelled an OMO, which was great for the market from two perspectives. One, it was seen as a yield signal. And second, one of the pain points for the bond market was the relentless supply of bonds from the OMO, both of which hopefully are not going to be in the front line right now. So I think 705 maybe, and there the bond should consolidate. The market has also kind of factored in a lot of bad news. I think we are expecting a small slip up in the fisc right now. I don't think the bond market is penciling in any rate cut between now and the next 6 months. And the market is aware that inflation, CPI, will be above 4% for the near foreseeable future. So I think a lot of bad news already factored in. Medium-term concerns still remain, though. If you go beyond just a short-term 705 kind of number, I think the concerns stem from uncertainty. On the fisc side, there are just too many moving parts, right? There's GST collections and how much of it is refunds. I don't think the market will have clarity till maybe the first quarter of next year. Likewise, commodity prices in oil and what that does, therefore, to the overall equations is a big question mark. Growth will remain uncertain as well. I mean, we'll see quarterly headline numbers. But again, this will not be a broad-based, non-corporate survey as yet. So we still don't know how the small, unlisted companies are doing. And that will remain. And plus, let's not forget, we also have a very uncertain global environment. While, if and when the Fed starts to unwind its balance sheet, while it's a very measured, slow process, it could just have an impact on us in emerging markets, and particularly in India, which has seen a lot of benefit of liquidity coming in. So uncertainty remains. I would still think in the medium term, our bond yields could go up. But for the short term, I think 705 should hold.
So I actually just wanted to take that growth question to Sajid also. Sajid, that's another facet of the S&P commentary that we got on Friday. That they did say that there is a downside risk to the outlook and the rating in case growth disappoints. We'll get the next quarter GDP numbers now shortly. Are you anticipating a marked recovery from that 5.7 number?
I would say there's certainly a recovery. I would not sure I'd use the word marked. We do see growth in the low sixes in this quarter, 6.3. But I think the broader point is not the next 1 or 2 quarters. The broader point is when growth does mean revert in 3 or 4 quarters, what is the level it mean reverts to? Does it go back to just 7%, or do we go back to the 7.5% that we saw, in the run-up to both demonetization and GST? And I think there are 2 wild cards here. Anand spoke a lot about the domestic factors. I think some of those drags will eventually fade. The wild card here is we've had 2 of the strongest global growth quarters in the last decade. And yet our exports have been kind of unconvincing, haven't showed the strength we would normally expect. So one question is, if you get reasonably strong 2018 global growth, will India participate in that? Countering that is oil prices, right? So if oil were to head upwards from these levels, that is an adverse terms of trade shock, which will impinge on growth. So the question is, which of these 2 forces will more directly impact India? Will it be stronger global growth and exports, or will it be higher commodity prices, which in turn constitute a drag on India's growth?
Okay, Anand, rupee today, dollar is at 92 and change, so we don't see any S&P impact on the rupee?
No, in fact, rupee should remain strong. Unlike the bond markets where actual physical flows into domestic bond markets, frankly, is more a question of sentiment than actual flows, given the lack of limits. I think you could argue that the surprise rating upgrade from Moody's and the positive chat, even from S&P, while it maintained a stable outlook, should do well for us in terms of FPI and equity, as well as an FDI over the medium term, if nothing else in terms of sentiment for exporters. And if you couple that with the fact that dollar is at its weakest since the beginning of the year, I think the sentiment for a strong rupee continues. There are underpinnings of worry, though. The fact is our current account deficit has turned negative in the last couple of quarters. Hopefully that subsides and export starts to pick up at some stage. But the combination of oil prices moving up and the fact that our exports aren't doing that great isn't good. And we could have permanent dollars across current account deficit, FDI and FPI and equity actually turning negative, which doesn't augur well for financial stability. So in the short run, I think the rupee strength continues. Dollar is just too weak globally, and the sentiment is just too positive for India. But it does board worries for the medium term.
Okay. Finally, you think 705 will be taken, or the market will hold 705 for fear that RBI is uncomfortable beyond that?
I don't think 705 will be tested, to be honest, but I could be wrong. At any rate, even if it is, I think, at that stage, we will expect the market to expect something from the RBI and therefore hold those levels. So,
what can be the something? Can they do OMO purchases?
I'd be very surprised if they did that, to be honest.
Yeah.
Having said that, I think the sentiment would remain one of, at 6.25%, nobody's talking about a hike as yet.
Okay.
So at 75 basis points positive carry, it just starts to look attractive. But I do think at some stage over the next 6 months, we should go higher from here. We could even see 7.25%. but I don't see that happening right now.
Okay, all right. Anant and Sajid, pleasure speaking with you, and I'm sure we're going to touch base with you in a matter of 3 days when the GDP numbers hit the screens. Thank you very much for joining us. Okay, we should be concerned about, and even that all of 5 basis points.
Oh, you're saying 7.25 in the next 6 months. So money getting more and more expensive.
Yeah, but that's also a sign of growth, I guess, if credit picks up.
If
so
growth
early signs
back,
of credit, yield rise need not be negative. It will be negative only for the day.
All right. On that note, let's take a quick break. We will be back talking equities with our technical experts, Ashwini Gujral, Sudarshan Sukhani,